Dear students, today we will discuss about inflation and we will try to decode India's inflation trajectory and its recent trends and policy implications. Before we are going further, let us see first what is an inflation. So, as we all know that inflation refers to the sustained increase in the general price levels of the goods and services. So, it is increase in the general price levels, general price levels of goods and services. So, for example, in the for example the current in the current period, the cost of the good is 100 rupees, and if the next period in the next period if the cost of the good is 110 rupees, we are considering there is a 10% inflation. So because there is a 10% general price levels increase in the general price levels of the that particular good, so it will applies to the services as well. So if you can observe, if the inflation is increases, what it will do? First, it will reduces the purchasing power of the consumer. So it will erode the purchasing power, and also it affects the consumer's behavior. It also affects the consumer's behavior because the consumer always wants to get the good value for the amount he is spending. If suddenly there is an increase in the price of the goods and services, he is not able to afford that goods. So it affects the consumer behavior, and also it plays a pivotal role in monetary policy making and fiscal policy making. So especially the monetary policy making. So even if we can observe that if the inflation levels are high, the policy of RBI towards the monetary policy is different. So the inflation plays a pivotal role in monetary and fiscal policy making. Generally, it measured in percentage terms. Inflation indicates how much more expensive a set of goods and services has become over a specified period of time. So generally, we are calculating inflation in two ways. One is the wholesale price index, the second one is the retail price index. So we can call it as a wholesale price index, retail price index. This retail price index we can technically call it as a consumer price index, that is CPI. So WPI and CPI are the technical terms we are using. The wholesale price index means it measures the average change in prices at the wholesale level. So it is going to measure the change of the price of the goods and services at wholesale level. So it includes goods traded in bulk and all, and it excludes the services. So at the wholesale level, we are considering only goods and we are not considering the services. So the WPI inflation, it reflects price movements only in the original supply chain because it is not included the services. Whereas the consumer price index, it captures changes in the price of goods and services purchased by end consumers, which means that the people who are buying from the retail shops. So it includes the food, housing, apparels, education, and also medical care. And it also includes services. That is why it is more relevant compared to the WPI. In the WPI, we are not considering services. In the consumer price index, we are using both goods and services. So that's why the CPI is more relevant compared to the WPI. So whenever in future classes also we can call, if we can call it an inflation, or you can automatically understand it is a consumer price index. If it is to the wholesale price inflation, that is a wholesale price index, we will specifically tells that inflation at the wholesale level. So while here the wholesale price index is an important macroeconomic indicator, and CPI based inflation is of greater significance for the general public. So if you can see micro level and macro level. So macro level, generally we use the WPI as the parameter, but if you want to see the micro level of the economy, generally it is suggested to use the CPI parameter because it directly affects the household budgets and forms the primary anchor for the India's monetary policy. So every country has its own nationalized bank. India is also has in the form of Reserve Bank of India. So the Reserve Bank of India operates under a flexible inflation targeting framework. So according to the agreement between Government of India and the Reserve Bank of India, which is adopted in 2016, the government has to maintain an inflation, sorry, the central bank, that is Reserve Bank of India, has to maintain an inflation between 2 to 6%. So generally we can call the target CPI inflation is average of 2 plus 6 by 2, that is 4%. So accepted bracket is generally between 2 to 6%. So the government of India says to the Reserve Bank of India that it is your responsibility to control the inflation through your policy measures. So whatever the policy measures you want to take, you can take it, but always the inflation should be in the acceptable range of 2 to 6%, and target the consumer price index as the target CPI inflation index should be 4%, which is the average of minimum and maximum. So if the inflation rate breaches this band for 3 consecutive quarters, which means that quarter means we are considering we have 4 different quarters, 3 different quarters, right? So if the inflation rate breaches this band for 3 consecutive quarters, the RBI is required to provide an explanation, and it needs to take a corrective action measures. So which means that inflation managing is the responsibility of RBI. That is one thing you have to understand. Clear? So thus the consumer price index inflation forms the basis of monetary policy decisions, such as an adjustment in the repo rates. Every time whenever the monetary policy it is announced by the government, Reserve Bank of India, everybody is interested on the repo rate. So based on this repo rate, there are many factors attached to it. If the repo rate is normal, if it is lesser, it will encourages the consumers to purchase the goods and services and use their money. If they are setting this repo rate as higher, which means that the RBI is not encouraging people to spend too much, so that it is going to control the inflation. So by using repo rate, RBI is trying to control the inflation. Of course, even the only repo rate is not the reason. There are other parameters as well, but repo rate plays an important role. Now, let us try to understand the conditions affecting the retail inflation in India, that is consumer price index. What are the various parameters which is very much affecting the consumer price index? The retail inflation in India is shaped by the multitude of the domestic and global factors. The first and foremost thing we can consider is food price volatility. So often generally driven by unseasonal rains, droughts and disruptions in agricultural supply chains. The second important factor is crude oil prices. So generally which influence the transport and energy costs, thereby affecting the prices across the sectors. The third one is the global supply chain disruptions. Recently we have seen that Russia-Ukraine war. Because of that, some of the goods which is coming from Ukraine has been struck down. So, and we have seen that COVID-19 pandemic. So those type of the factors generally. So it will disrupt the global supply chains. Obviously, which increases the inflation in the respective countries, which applies to India as well. The fourth one is the currency fluctuations. Currency fluctuations. Whenever we are trading with some other countries, we are trading mostly in the US dollars. Of course, there are some other interim agreements are also there using the bilateral swapping agreements, but largely let us stick only to the US dollar trading. So the currency generally fluctuates. When the currency fluctuates, the cost of imports is higher because we are continuously importing the crude oil. So crude oil is very much important component. So if the current, for example, today $1 which is equal to 80, and suddenly US dollar is increases to 85 rupees, the cost on India is increases obviously because the cost of import is increases. The other thing is government policies. For example, which includes the taxation. So ease of the GST or giving some concessions in the GST, excluding excise duty charges or imposing excise duty charges, and supporting the farmers using minimum support prices. Many government policies, they also affect the monetary policy, and it is also affect the consumer price index. And last important factor is demand side pressures. Now currently we have experienced COVID-19 pandemic. The post COVID-19 pandemic recovery, generally every country is coming out of that economic disruption. So obviously there is a lot of demand from the several countries for the same good. So if that kind of the demand is there, obviously the inflation will not be under the control. So these are the conditions which affect the consumer price index. Now let us try to see the inflation trends in recent years. Inflation trends in recent years. So India's inflation has exhibited considerable volatility over the last 5 years because the COVID-19 is also included in that. So if you can observe the financial year 21 to financial year 23, the retail inflation, that is consumer price index, is hovered around 6 to 7%. We know that the range of the inflation to be operated by the RBI, the suggested one is a 2 to 6%. So between financial year 2021 and 2023, the retail inflation is between 6 to 7%, predominantly breaching the RBI's upper tolerance limit. So this was primarily due to pandemic-induced supply shocks and geopolitical disruptions and global commodity price surges. But in financial year 2024, the retail inflation, that is consumer price index, is averaged at 4.6%. Right? So making a return to within the RBI's comfort zone and lowest level since financial year 2019. But we cannot attribute it as a complete real disinflation. We cannot consider that because during the COVID-19, after the COVID-19, the price of the goods and services is increases because of the demand, and over a period of time when the demand becomes normal, the demand has been reduced so that the price of the goods and services has been reduced. So in the financial year 24, by the time the demand has been settled, so that's why the inflation has been reduced from 6 to 7% band to the 4.6% band. So this 4.6% band is almost the comfort zone of the RBI, which is between the 2 to 6%. The average is anyway 4%. Right? So in April 2025, the consumer price inflation stood at 3.2%, further easing from 3.3% in the March. So in the March 2025, the consumer price index is 3.3%. Right? Now in April 2025, it stood at 3.2%, further reduces, and it represents the lowest level in last 6 years, which is a good parameter. The wholesale price index, which had been negative or muted during this period, it was recorded as 0.9%. So wholesale price index is 0.9%. But mostly we are not considering wholesale price index to understand the macroeconomic situations. Now if you can see the reasons behind recent easing of inflation, initially it is 6 to 7%, later it is 4.6%, now it reduced to the 3.2%. So if you can see the different reasons behind it. So we are trying to understand these some of the reasons. The first and foremost thing is stabilization of crude oil prices. Stabilization of crude oil prices at the international market level so that it reduces the logistical and energy costs. The second one is expectation of above normal monsoon. And in the last 2 years, the reasonably, there is a good monsoon, and there is an expectation that in the further coming years also, we are expecting above normal monsoon. The third one is base effect. We're already told that due to global supply chain disruptions during COVID-19, some of the price of the goods and services has been significantly increased because of the demand side pressures. Once the demand was settled, then obviously the goods and services has been reduces. Generally, when we are calculating the inflation, we are always calculating with reference to the previous period. So in the previous period, the rates of certain goods and services may be higher due to some reasons. Maybe in the next quarter, it might be less. So that is also one of the important factor we have to understand. The fourth one is improved supply side logistics. The in the pre-pandemic and during the pandemic, the supply side logistics has always faced the disruptions, and those supply side disruptions and supply side logistics has been tremendously improved. The other different reasons include some of the government measures, because the government maintains the food buffer stocks and maintaining enough onion, tomato and other important foods, and also it is trying to curb the export of the essential commodities, and it is not allowed to export rice for certain period of time, and it is also rationalized some fuel taxes. So the government reduces some 10 to 15 rupees at one particular point of time. All these things, those are all government policies are also one of the reasons. So this benign inflationary environment provides the greater leeway for the policymakers. On the fiscal front, the government has already increased the excise duties on fuel to raise 30,000 crore in additional revenue without straining to the consumers. So on the monetary front also, the RBI may explore a 50 basis point repo rate cut over the next two reviews. And if it is cutting further 50% more, means it is giving leverage to the consumers to spend more, which is offering a more accommodative stance to the stimulating growth, because always we are expecting the stimulative growth. In conclusion, we can say that India's inflation narrative has undergone a marked transition from an era of persistent price pressure to one of comparative stability. So now almost we achieved the stability with respect to the inflation. So the moderation in retail inflation, crucial from both a policy and consumer standpoint, signals resilience in macroeconomic fundamentals and effectiveness in monetary management. It support if supportive conditions, which means that the stable oil prices and a strong monsoon, if it persists, India could be poised for a prolonged phase of low inflation, robust consumer sentiment, and accommodative policy space for the RBI. This opens a critical window for balancing price stability with economic growth. So ultimately, we are always look for price stability and vis-a-vis with the economic growth. This is about the current inflation targets. We will see in the next class for the another interesting video with another interesting video.